Strategies president. It's great to see you again. And, we've been sort of following, I think you've well captured this turn in yields when we were at, historic lows and then we shot higher. And as you've written and talked about, the Fed was behind the curve. Where do rates go from here? What is the bond market telling us? And what happens with this recession?
Kelly, those are all great questions. I think the Fed is in an impossible situation, having miscalculated inflation for so long and having delayed the rate hikes and having inflated the balance sheet. What they find themselves in today is that inflation is very high. A lot of it is beyond their control, like the Russian war, the Shanghai shutdown. Those are causing it. So the Fed is very, very much behind the curve. So that is what you see taking place. In terms of what it does to the economy, this reminds me so much, Kelly, of how we were in 2006, 2007, when people were still saying, oh, is there ever going to be a recession at all? And recall that in July 2008, when we were at the verge of a big drop, the European Central Bank increased interest rates in the beginning of July, saying the global economy is very strong.
Right.
I find a lot of similarities. Yes, the labor market is very strong, but I don't think it is going to stay that way. I think the Achilles heel in all of that, Kelly, is the fact that inflation is way, way too high. It's going to take a lot of Fed tightening to bring it down anywhere near 2%. They may not be able to do that for a while, and that is where the risk to the economy lies.
The risk because it's just going to run hotter than the Fed wants for longer. What is the risk that the Fed has to basically settle for that higher inflation and a slower than optimal economy, which is sort of the definition of stagflation? Is that what we're in for, including, in your view, a full-fledged recession sometime next year?
Tyler, that is a great question. The Fed could have settled for a higher rate of inflation persisting for a longer period of time. Let's say they would have settled at 3 or 3.5% and say we are going to be there, not at 2%. But that option was lost in the middle of 2021. They have since been inflating the balance sheet. They have continued with zero interest rates for almost 1 year longer, which means today the Fed does not have that option of accepting a slightly higher inflation rate. The inflation rate is going to be significantly higher. Of course, Jerome Powell can say, I didn't anticipate the Russia-Ukraine war, but nobody does. You do not conduct monetary policy assuming the world is going to be perfectly stable to allow you to do your tightening. So by delaying it, he lost degrees of freedom and now is going to force to tighten into a slowing economy. We saw the 2 to 10 yield curve already invert once. Mm-hmm. We have come back to positive level, Tyler, but I think we are going to invert again. And that's what happened repeatedly in 2006 before the Great Recession began in December 2007.
If I accept your hypothesis here of a slowing economy, potentially a recession with higher than optimal inflation, what should I do to protect my capital or take advantage of pockets of opportunity? What should I do?
You should behave very differently than you did in past recessions and past periods of high inflation, because today you're going to have a combination of both of them. That means in your behavior, you cannot just go into bonds because the bonds will lose value due to inflation. You cannot go into equities because equities will lose value because of a recession and fall off in corporate earnings. So what you do is to look on the short end at short duration, high grade fixed income paper. You look at cash, you look at gold, and longer term, you look at commodities. You look at globally diversified areas to go into like real estate, so you can protect your value against inflation for the next 5 to 7 years. So this argues for you to go away from a typical 60-40 investment strategy, Tyler, and to be very innovative in terms of where you're going to be over the short term and the medium term.
All right, that's the prescription from Sri Kumar. Sri, good as always to see you. Thank you.
Thank you, Tyler.
You bet. All right, coming up.